All right, okay, so let's go through the answers to the questions. What are the three core teams? Many of you got this right. So that would be origination, distribution, and structuring. Many of you answered restructuring. I've not given marks for that. Restructuring is not the same as structuring. Okay, so this is origination, distribution, and structuring. What are their functions? Most of you said to raise capital. That's not good enough. You have to give the specific functions of each of the different types of teams. Okay, so origination's function is to contact potential issuers, okay, get in touch with potential issuers and sell them on the prospects for a primary issue of either debt or equity, and then basically to compete against the other investment banks who are also to try and win the lead manager position, which is the most lucrative position in terms of fees. So that is the role of origination, to convince the potential issuer that our investment bank is the best position to lead manage your PCM issue. Okay, so that is the basic role of origination. That is what the answer should have been. Then distribution is again to convince for upcoming PCM issues. Okay, to convince the institutional investors to buy to subscribe to those issues. Okay, so in a PCM issue, you would actually subscribe to the issue, and that's how you would buy it. Okay, so the role of distribution is to go and to talk to these institutional investors and convince them to subscribe to the upcoming PCM issue of either debt or equity. And then structuring, of course, as we said, is involved in more complex transactions where the issue is not a plain vanilla issue. So structuring will get into the way the whole deal is going to be structured if it's a slightly non-standard transaction, and they would interface with other divisions like tax, legal, regulatory branches of the divisions of the investment bank, and try to craft a customized issue. Okay. All right. So again, we have to have 2 marks for Kalra and Nagpal in the same team. Okay, they are involved in some discussion, which is not so. Akanksha, your champions are performing. No, there's no doubt. There's no doubt. You can't have benefit of doubt when there's no doubt. In Dharam's case, there was a doubt. So because I wasn't looking at the screen at the instant he came in. Okay. All right, so let's go back to the discussion. Okay, so functions, so structuring is also understood. In the case of non-standard issues, the entire customization, the customization of all the features of the issue will be taken care of by structuring. They will of course also have to interface with origination and distribution also to assess the preferences of issuers and investors. Okay, because you can't customize a product without basically taking into account their requirements. 3 core functions in the front office of a SCM operation of an IB is sales, trading, and research. Some people said trade. I've given, I think, 1 mark for that. I said trade. Trade is not the same as somebody else also said trade. Okay, I think Tushar. So that trade is not the same as trading. Okay, so sales, trading, and research is what the answer should have been. Okay, and again, what are their functions? Again, not properly answered. You have to give the separate functions of each of the desks. Okay, or the functions. So sales, we'll start with trading, because trading is really what the heart of the operation is. It's the market making operation. Trading is a market making operation. It has to make markets in at least all of the securities which the PCM division has managed and committed to make markets in. Okay, so even if you're not the lead manager, you might have made a commitment to make markets. So you have the main function of the trading desk is to make markets in securities. So obviously you have to quote 2-way prices. You have to make markets in those securities where the IB has made a commitment to make markets. Okay, and in fact they actually might, because they are already there in that position, they have the setup, they may actually make markets in a lot of other securities where they don't necessarily have a commitment, but they'll still try and pick up market making volume. Okay, and and remember how market makers make what is the ideal situation for market makers to make money?
Yes.
High volume and quiet markets. Okay, so not a lot of movement and high volume. So the market making business is heavily focused on basically volume generation, because that is the part that you can control. To some extent, you can make some efforts and generate volume with your sales desk and with the support of the research desk, but you can't really do anything about the quiet markets part. That is just luck. If it happens, it happens. So The main function is the trading desk to provide the market making facility. Okay, so as you see here, as you can see in your when we looked at the different firms, different types of firms that exist in the financial sector, and one of the types of firms we've noted is market makers. Okay, so what is happening here, if you notice, actually is that's why I said that. So so investment banking is also not market making, although you will find the market making function in many investment banks, but you have to understand it separately as a market making function. So the way this table has been designed is we are looking at core functions, okay, sort of atomic level functions, which we have stripped out and looked at them. So in fact, you will find market making in the investment bank, in the SCM division of the investment bank. What the trading desk is doing is market making, but we are not listing it as a function called investment banking, okay, because we are referring to investment banking mainly as the PCM activity. Okay, and we know that it has to be supported by the SCM activity. So what the trading desk is doing is actually market making, and here the only difference is because in SCM you don't make markets in currencies and commodities. Okay, so you make markets only in the debt and equity securities. Okay, so that's what the trading desk is doing. So this is the part that I just wanted to mention, that to understand this, that's the SCM operation. The trading desk is actually a market making function. It's functioning as a market maker in debt and equity securities. It is part of an investment bank, but it's not what is called investment banking classically. All right, so the third function that you have to talk, so the other two functions obviously is let's discuss it. We're discussing the functions of trading, sales, and research. It's already been discussed, but what do you have to say? I'll just briefly cover it again. So sales, again, so trading function is understood. Okay, so the job of sales is to drum up volume for the trading desk. So sales and research actually, so in the SCM operation, the heart of the operation is the trading desk, because that represents the market making commitment of the investment bank. And so the sales and trading exists to basically support the trading desk and generate enough volume. Okay, and so the sales job of the salesman is basically, you'll have institutional debt sales and institutional equity sales. These are the kind of designations that you will find, and these guys go and talk to institutional investors in equities and debt, and they try to generate, basically try and create a buzz around some stocks which the trader wants to trade, and then make those guys, incentivize those guys to trade with their trading desk. Okay, that's the job of sales. And sometimes these guys are also called sales traders. Okay, sales trading is also a designation you'll hear, but sales traders actually they would exist more in in currencies and commodities. Okay, that designation is more seen in currencies and commodities. We'll just look at the sales, trading, and research distinction in the SCM operation as we have discussed it. Okay, so sales and research also has to support the trading desk. So when the sales guy is actually going to the institutional investor and trying to convince him to trade in stocks of certain companies, okay, then the investor, how does he form a view? Because if he has to trade, he's going to either buy or sell. Right? So in order to either buy or sell, you need to have a view on the stock first. Okay, so how do you form the view? You form it through research, obviously. Either you do your own research as an institutional investor, or you rely on the research provided, sometimes a combination of both. You rely on the research provided by the IB. Okay, so that's where the role of research comes in. So the role of research in the front office is to create research reports on on particular securities, which will help institutional investors to take a decision as to whether to buy or to sell. Is this clear? That's the role of research. Okay, and something else that, because some of you may be interested in research roles, something else that you have to understand in terms of a developing scenario in international markets now. Now, historically, what has happened is, and research, if you see here, I have given the research as a advisory function. Okay, here I've listed research as an advisory function. Okay, and I've listed it as independent research. So when you see the research division within a SCM operation, okay, the ideal way to think about it in this kind of a framework where we are looking at atomic level functions, you think of it as if it's an independent research function which has been put into that SCM slot. Are you following? So that's why, because research is a separate function. Research is an advisory function. Okay, unlike trading is not an advisory function. It's a execution that you have to do. So it's not an advisory function. The research is an advisory function. So the way to think about the SCM operation is that you have the sales, trading, and research on the front office. Okay, so the trading is actually a market making function here. Okay, the trading is market making. Then the research is actually an advisory function. So when we think of the reason this is listed like this, that you could actually have firms which are pure market makers, which are not part of an investment bank. You could have firms which are pure market making firms. Okay, you do have some firms like that. And you could also have firms which are pure research firms. They only provide research. Are you following why I've made this framework this way? That everything has been stripped down to an atomic level entity. So research is of advisory function, okay, and you do have many firms in the sector, in the financial sector, which provide only research. They don't have any other operation. They are just selling their research. Okay, so that's why. So when you see and similarly you have market making firms who have no investment banking operations. All they do is make markets. They just exist as a market. That's their only function. So that's why the way to see it is that when you're looking at the sales, trading, and research inside an investment bank, okay, this is all in one box. If you see sales, trading, and research inside the investment bank, the right way to see it is that as if you had an independent market making operation in those securities inserted into the front office, and that's the trading desk. Are you following what I'm saying? I hope people are not getting confused. Okay, let's try and use the pen to understand this maybe, but when we are not capturing it on so if we say here, see, this is say sales is separate, okay, trading and research. So this sales, trading, and research that you're looking at, we'll just collapse this. What happened? Where is it? Where did I write that sales, trading? Oh, here. Okay. Yeah. So what I'm saying is that sales, trading, and research here that you see, okay, this is part of the front office of an investment bank. Okay. So what I'm saying is the way you have to think about it is actually of a front office in the SCM operation. Okay. The way you have to think of it ideally is that it's as if you had the trading division, the trading desk is like functioning like any other independent market maker in securities. Okay, it's just that it happens to be part of the SCM operation. Are you following? The function the reason it is listed like this, the function that it is performing is no different from an independent market maker. Okay, you have many firms who are independent market makers. Okay. So so the trading desk is functioning like any other independent market maker. So when you see the trading desk inside on the front office of the SCM operation, you think of it as an independent market making desk which has been kind of just inserted into the IB framework. Are you following? Not following. It's very difficult. Maybe I'm not explaining it well. But anyway, maybe I'm overcomplicating it also. It's just like, I don't know how to explain it. But the point is that you have what the trading desk inside an SCM operation is doing is no different from what an independent market maker would be doing. There are some firms in the sector whose job is only to make markets. They are not part of any investment bank or anything. They are just a pure market making business. Okay. So these guys, what they're doing, the independent market makers, and what the trading desk inside an investment bank is doing is qualitatively the same identical function. It is just that the trading desk happens to be located inside the front office of an SCM operation. That's all there is to it. Is this clear? Okay. Now that's all there is to it. So don't don't complicate it further. You can just think about it a little bit. Similarly, there exist in the industry, in the financial sector, there exist many firms who are pure research providers. Okay. Like in India, you might have seen this. There's a firm called Value Research, which provides research on mutual funds. Okay, so what is that guy doing? He doesn't have any other operation. He's just producing research and selling research. Okay, that's a pure research firm. You have many such firms all around the world. Okay, their role is they are just pure research firms. That's why I've listed them, and their function is actually not market making or anything like that. Their function is an advisory function. Okay, under advisory we have many types of activities, one of which is M&A. Okay, so one of the functions under advisory under the category of advisors. These are people we have called them advisors. So one of the types of advisors you see is research firms. Okay, so the pure research firm, again, what I'm trying to say is that when you see sales, trading, research inside the when you see sales, trading, research as part of the SCM operation of an investment bank, the research desk, the research desk in that operation is no different qualitatively than what an independent research firm is basically. It's the same. They are doing the same function. They're performing the same function. They are both producing either FA or TA type of research on various securities. Is this clear? Is this clear now? You're following? Okay. The only difference is that these guys, when you list them as advisors and independent research firms, because here at this stage, they could also be producing research on commodities and currencies, which an SCM operation will not produce, because an SCM operation will only produce equities and debt research, because capital markets is concerned only with equities and debt. Is this clear? But functionally, the idea is the same: is to generate FA and TA analysis, which will help people to take decisions as to whether to buy or to sell the stock. Clear? I don't know, many of the faces in the first period, but many of the faces seem to be like kind of lost. What happened? Are you following or not? Okay, everybody's like half dead at 9:30 in the morning. Okay. What happened? Coffee? You need coffee? Yes, sir. I have always advocated for free coffee for the students, so that outside the class there should be coffee. Okay. All right. So let's. So this covers the answer. Long answer, but this is how the answer should have been given. Okay. So sales, trading, and research. I just want to mention a few things about research. The few things about research. What is happening is, see, historically, what has happened is the research function has not been separately priced. Okay. So if you go back to this framework, we had. So we have sales, trading, and research inside the SCM operation front office. Okay. Now what happens to the research is that the research, how does the, you see why sales and trading, sales and research support trading. Okay. What the research, how do these guys, they have to pay the research analysts, equity analysts are quite well paid. Okay. But how is the firm making money out of their research? What historically they have done, and which continues to be the practice outside the EU. Okay. EU is European Union. Okay, so what continues to be the practice historically has also been historically the practice is that the research has always been given free. So let's say Credit Suisse is producing some equity research, so they would give all the equity research produced by their research team, they would give it for free to all their institutional clients. All the institutional clients that the sales team is going to go and pitch to. Okay, so the sales team will go and meet the institutional clients and say, okay, now I will put you on the mailing list for our research output. Okay, so they will get the research from these guys, the institutional investors who these guys are targeting. Okay, they will get the research for free. And the way the bank gets compensated is that in return, what the sales guy will say is that if you want to do some trading, please do some trading with us. Okay. So that's where basically how the bank gets compensated is that they get trading volume. So the equation is not 100% clear cut. You give research for free, and then sometimes you'll get some trading volume in return. Okay, this is the way it has worked even outside the SCM operation. Okay, SCM is only concerned with capital markets. So when you go into these kinds of advisors, when they exist in, let's say, the treasury division of a commercial bank. Let's say when the treasury division, I've given you that technical analysis bulletin, remember? I've given you the technical analysis bulletin which I used to write for Standard Chartered. Yes. I've given you that those historical bulletins. Okay. So this bulletin again that is what? That is technical research. That is technical research being produced by the treasury, and I was functioning as a part of the research team, right? So that used to be given free to the clients of Standard Chartered. And how would we get compensated? The way we would get compensated is that when they wanted to trade in foreign exchange, they would call our trading desk. Is this clear? That is again what is happening. That is also a market making function. except that it's not an SCM operation because it's trading in foreign exchange. So that report used to be mainly focused on foreign exchange. Okay, so that was a market making function. So when you see a foreign exchange trading desk inside a commercial bank like Standard Chartered, okay, if you see a foreign exchange trading desk, that's also nothing but a market making function. Okay, except that we wouldn't call it a SCM operation because foreign exchange is not part of the capital markets. Okay, so it's not trading in equities and debt, it's trading in foreign exchange or commodities, etc. Okay, so that's again a market making operation. Are you following? The same setup even in other market making operations. The research function has been historically given out for free. The research output has been given out for free. So whether it's in the foreign exchange trading desk of a commercial bank, okay, which is engaging again in market making. So you have to understand that the core function is market making. When you see the foreign exchange trading desk in a commercial bank and when you see the equity trading desk inside an investment bank, okay, they are qualitatively the same. They are both market making operations. That's what I'm trying to emphasize here. Is this clear now, the point? They're both, the function that they're performing is both market making, except that one guy happens to be doing it in equities and one guy happens to be doing it in foreign exchange. But you should understand conceptually that the function is the same. It's a market making function. Okay, you are just operating in different asset classes and different markets and making markets by quoting two-way prices. All right, and customers will keep calling you. So even in if you look at, since we just started the discussion about the foreign exchange trading desk of a commercial bank, because foreign exchange is such a big market, you should have some idea about it. Okay, so again you'll see the same kind of setup. When you go to this we described as part of the SCM operation of an investment bank. Again you'll see the same kind of setup here. Okay, as you see here. Again here on the foreign exchange trading desk of a commercial bank, of a large commercial bank, you'll see sales, trading and research. So the trading guys will be making markets in currencies. Okay, and then the sales guys, there are many designations like foreign exchange sales. Sometimes you have specialized designation like FX option sales. Okay, so that means that guy's job, that salesman's job is to purely just sell FX options, and he's going to support the FX option trading desk. Okay, so if it's just plain FX sales, he will support the FX spot trading desk. Remember when we looked at our framework? What does our framework say? So there are many types of instruments. Now again we are rehashing the framework that when you're looking at markets within any asset class, in this case we are discussing currencies. Okay, so you could have spot markets, okay, which is where most of the volume is, but you could also have option markets in currencies. All right, so that's why you will see sometimes you'll see designations like FX option sales. So this guy is head of FX option sales. You might actually have a big team of like in City Singapore, they had a big team of people just focusing on FX option sales. Okay, and then you could further subdivide that depending on the volume of the size of the operation. You can further subdivide that into private bank and the institutional customers. So mainly here we are discussing institutional customers. So again, so you will have the same setup in the market making operation for foreign exchange in a commercial bank treasury. So they'll have sales, trading, research. Trading guys will make markets in foreign currencies. Okay, like you've seen on the Wanda platform, those bid offer prices they are posting. That's all being posted mainly by commercial banks. Okay, and then the sales teams will go and talk to various investors, corporate clients, institutional clients, all those guys who need to trade in foreign exchange. Okay, so many people need to trade in foreign exchange because all this international trade is going on. Investors are investing across borders. Okay, many US funds invest outside the US, so they all have foreign exchange requirements. So these are the kinds of people that the sales team is going to contact, and once again they're going to give out the research for free. So then you'll have the research team on the foreign exchange desk. You'll have the research team whose job is to produce research on foreign exchange. Okay, so it'll be TA and FA research on foreign exchange, and this research will be given for free to the institutional investors by the sales desk, and the sales desk will say, okay guys, please do some trading with us. Okay, in return I'm giving you this research for free, and in return please do some trading with us. Okay, so they will be saying this to the corporate desk as well as the institutional to the corporate customers as well as the institutional customers. So are you getting the framework now, how a typical market making operation works? Okay, it is supported by sales and research. Okay, and this is where and so you see one manifestation of that in the SCM division of an IB in the front office. Okay, so now the part I wanted to emphasize about research to art, because you need to understand what is happening, how the trends are shifting in the industry. So there's been a new regulation in the EU called what is that regulation called? I mentioned it briefly. Do you remember it? In the last class I mentioned it briefly. Does anyone remember? There is a regulation in the European Union called MiFID II. Okay, so there was MiFID 1 also, and you can just Google and check out what MiFID stands for. MiFID stands for actually Markets in Financial Instruments Directive. Okay, so it's a regulatory measure from the EU. Okay, so here you can see once again you can see here the affirmation or the sort of vindication of this framework. Why this framework? Why I have not taught you asset classes are equities, debt, futures and options. Why futures and options are not asset classes, they're actually instruments. Okay, so you can see it in the EU regulation, which is MiFID II. MiFID stands for Markets in Financial Instruments Directive. Okay, so you see that these markets, what did I say? That there are asset classes. Okay, in the asset class, in any given asset class, you can have many types of many markets. Okay, and each market will be in some instrument, can be in some instrument or the other. Okay, so you can have FX spot markets, you can have FX forward markets, you can have FX swap markets, and you can have FX option markets. Okay, and also futures as well. Okay, so that's the point. So that's where you see the markets are in financial instruments. Are you following? That's why in your textbook, in the first IPM textbook, you have a taxonomy which says asset classes are equities, debt, futures and options. That's wrong. Okay, futures and options are not asset classes, they are instruments. Okay, so this is the right classification. You can see this been vindicated by the EU directive, Markets in Financial Instruments. Now, one of the things that MiFID II does, it comes up with a lot of regulations. One of the things that MiFID II is saying is that this business, we don't like this business of giving the research for free. We think it's kind of shady. The European regulators are saying that we think that business of giving the research for free is kind of shady. Okay, don't do that. Sometimes there's also another practice that many of these SCM operations had. They used to provide, they used to provide like infrastructure to the institutional investors. So there's like, you might have a let's say Sher Khan as a brokerage. Okay, might want to, or which also runs, let's say, a trading desk, a market making operation. They might actually give some computers free to HDFC Mutual Fund. And they might give some software for free to HDFC Mutual Fund, saying that, okay, guys, please trade with us in return for all this. Okay, so many of these, what the European regulators are saying is that this practice is kind of shady and it creates a conflict of interest. Because what the Europeans, to understand all these dynamics, because nothing in real life happens in a silo. Okay, it is all the finance and the legal aspects, everything is all connected. Okay, so what the European regulators are saying is, so you should be able to bring in whatever you've learned in law to the picture, that what the European regulators are now saying is that this represents a conflict of interest because these institutional customers that these guys are targeting, okay, so these guys are targeting all the their customers. Okay, so the customers are mainly, let's say, we'll just use this short word FII. Here we call them FII, so I'm just going to call them II. Now I'm just going to call them II, okay, for institutional investors, but I don't want to say this big word every time. So these guys, the sales desk is contacting IIs, but these IIs are who? These are actually pension funds. These are pension funds. Institutional investors are pension funds and mutual funds. Okay. Now these guys, what the regulators are saying is that these guys have a fiduciary responsibility. You understand what is a fiduciary responsibility? It is like you have a responsibility to look out for, take care of the interest of someone else. Okay, it's like a trustee. You heard of a trust fund? Yes. Okay, so a trustee is basically not the beneficial owner, okay, of not the equitable owner of the assets. He's the owner in name, but he has to run the trust fund for the benefit of the beneficiary. Okay, so here then basically that's what is the idea behind a fiduciary responsibility. So similarly, when HDFC Mutual Fund has taken money from various investors, okay, then let's say the California state teachers pension fund is running pension fund money. They are running that money on behalf of the teachers who are going to one day retire. Okay, it is not their own money. So in all these cases, there is a fiduciary responsibility, and what the regulators are saying is that if the institutional investors get the research for free, then it creates a conflict of interest, because then they might go and trade with Credit Suisse, even if Credit Suisse is not giving the best price. So the idea is that they have extended the idea of the fiduciary responsibility. What that means is that the IIs also have to get the best price for every trade. Are you following? Because they're not managing their own money. They're managing money for teachers who are going to retire one day. They're managing money for investors who put in money into the mutual funds. Okay, so they have to ensure, they have a responsibility to ensure that they get the best price for every trade. And what they're saying is that if they have been getting free research from Credit Suisse, then if Credit Suisse is still not, even if Credit Suisse is not providing the best price, they may still have to go and trade with Credit Suisse just to honor the obligation that they have incurred an obligation by getting research for free. Are you following the argument? This is a very interesting argument, and it's important for you to be aware of this as well. So it's not just finance, there's also legal aspects which come into how the world actually operates, because this has real implications in how businesses actually run. Regulation has real implications on how businesses run. So have you followed the logic I've given? Are you following the logic? That because institutional IIs are managing money for other people, they have what is called a fiduciary responsibility. Okay, that means inter alia, that means that you have to get the best price for every deal. But if you're getting free research from some people, you might trade with them just to honor that obligation, and even if it's not the best price. Are you following now? Is this clear? So that's why the EU MiFID II says no more free research. Okay, now this has serious implications for people considering careers in research. And who knows what will happen, whether MiFID II will apply largely only in Europe, or it might be extended to other parts of the world. But what research analysts, people who want to be in research should be ready for is that you have to be, now you're going to become much more accountable. Now what's happening is, now banks are being forced to charge for their research. So MiFID II says you have to charge for your research. So every bank is now saying that, you know, if you want to talk to our analyst, okay, if you want to talk to our oil and gas analyst, it will cost you like $4,000 an hour or $5,000 an hour or something like that. Okay, and so many of the institutional investors are saying your guys are not worth that much. So there's a serious sort of amount of turmoil in the research business, because now the banks are being forced to charge for research. So that now the question becomes, what is the fair price of this research? What is the real, how much is the market really willing to pay for this research if they have to pay for it? So that is one big question that has come up. So for people who want to become research analysts, one of the things you have to be aware of is that you better make your research very, very effective, so that people, what happened? You want to switch off the AC? Why? It's cold. Get a shawl, no? Shalimar Bagh is nearby. Go get a shawl. Don't Soja, it will become very hot there. Now it's already winter. Now you should be getting your winter wear. It will become crazy if we switch off the AC. It will become too warm. Okay, guys. So I wanted to mention this important point about those who feel cold, please get shawls, okay, from in the future. What happened? Okay, have you understood this point that I made about MiFID II, about what is happening in how the research business is changing? So you need to understand both. You need to understand how historically research has been priced, which is basically it's not been explicitly priced. This is what we call a bundled service. You heard these terms, bundled and unbundled. Okay, so now what MiFID II is forcing people to do, okay, all market making operations are now being forced to, which includes the SCM operations, okay, all market making operations which were supported by sales and research desks are now being forced to unbundle. This is how we would use the word. Now they are being forced to unbundle the research and sell it separately. Okay, now which is putting tremendous amount of pressure on research analysts, because now the market is really going to price what they're actually worth. Okay, they're going to really put a price on their research. So this is something you have to be aware of as a developing phenomenon. Okay, so MiFID II has come into force from January of 2018. Okay, so you should be aware of all these things. Okay, so let's go back to so that completes the discussion on our it's a long discussion, but I wanted to add these elements to your discussion of the market making operations inside a SCM unit. So we'll continue with our discussions with going down the So I was telling you about research output on zero hedge. Yesterday there was an article about Goldman Sachs doing some research on the BICS term structure that was on zero hedge. So you can dig that up and get a feel for how research is produced. If you want to look at other equity research reports, I'll just give you, I don't know if they still have it for free. All right. Okay, so research. So what we have discussed as a topic, I'm just giving you since you have the video, I'm not giving detailed write-up on that. But what the topic that we have discussed just now, that we have finished discussing, is the traditional pricing of research and the new developments due to MiFID II. Is this clear? Okay, I'll just give you one more point here, just here. It should be in that other point, but you can actually look up this Zacks. If you're interested in how equity research reports are produced, look on Zero Hedge, you might find some of those reports. Unlikely, but then you can also look for Zacks. Zacks produces some equity research reports, and they used to give them out for free earlier. Now I don't know whether they're still free or not, but you can just check Zacks equity research reports. I'll just give you, so if you want to get an idea of how it is written, okay? All right, okay, so middle office, we have all discussed all of this stuff. Now we can go on to, we go back to our framework and see what we want to study now. Agency brokers, I think where we ended the other day was basically agency brokers, right? This is where we were. This is a little bit confusing because I put in sales trading. I'm going to just widen this once more. All right, okay. So agency brokers, everyone is clear about agency brokerage. Okay, the reason we call them agency brokers is that they're not acting as a principal. Okay, they are pure brokerage firms. Okay, that's why if you see here, what have I listed here? This I've listed as a standalone category. So one of the types of players you have in financial markets is this category of agency brokers. Okay, all they do is brokerage. So, all right, so then we can go on to the next category. Okay, exchanges and clearing houses, this we have already discussed extensively. So you know what their function is. Their function is essentially to manage, to host and clear exchange traded markets. Is this clear? Exchange traded markets you already understand now. So also we have to again see these people as separate types of entities. So what this framework does is it basically lists out all the separate types of pure functions that are being performed in the finance sector by different types of firms. Okay. So exchanges, I'm not spending money. We were supposed to go into traditional and alternative asset management. Okay, that is the discussion that we were supposed to have. I need to just let me just. Traditional versus, and there was a table also. Okay, I will put this table into your folder, so you will not need to note this down. But let's just understand, this is a very important distinction also to be clear about all these concepts and how to analyze different types of players. Okay. So it's important to understand the difference between the AM is normally referred to, I'm just going to say TAM and AM from now on because they're shorter. Okay, so AM is also loosely referred to as hedge funds, but the proper terminology would be AM. So, but obviously because that when you say it, the full word is the full expression is long, so people just say hedge funds for short. But you should be clear that this is actually the proper term, AM. Okay, now here, traditional, you can read most of the stuff. Let's take the first point, okay? If you remember, some of you had come during your summer training to discuss about some problems. And at that time, I'd mentioned to you about whether the fund that they wanted you to manage is a long only fund. If you remember, we had that discussion. Some of you were there, Tanvi was there, Double A was there, maybe Sinha was also there. Okay, so we had that discussion in 201. Okay, so one of the things that happens is one of the ways to understand whether a fund is a part of the TAM universe or the AM universe is that historically you've had most of it. That's why it's called TAM, traditional. Historically, the dominant type of firm has been a firm which only trades from the long side. Okay, so typically the mandate, remember this investor mandate that we discussed while discussing decision problems. So historically what has happened is that the investment management business has been, now we have to deduct marks for Giri also. He is deep in conversation with somebody. Giri is communicating, sending out signals. Giri is also somebody like Ayush has to be made to sit on the, you also should be made to sit on the front bench so that you don't lose marks for your team. You are losing marks for your own team. Minus 16. You are giving term. Why? So you are giving tough competition to Tanvi's team. Okay. Alright, okay guys, now first distinction to understand, historically investment management firms have been long only, which means that they are not allowed to go short. You understand the difference between, you understand what is meant by net short? So if I buy 1,000 shares of Apple, okay, yeah, the net position would be short. So if I buy 1,000 shares of Apple and then I sell 600 shares of Apple, my net position is still long 400, okay. But if I start out by going short Apple, okay, then my first position is a short trade, then I'm short, let's say 1,000 shares, that's going that means my net position is short. I have a net short position. So that is not allowed. In traditional investment management mandates, okay, most of the time the mandate included this long only rule, that you can only buy and sell equity and debt you can only buy, initially you have to maintain a net long position. The point is that you have to maintain a net long position in equities and debt. That is the mandate that was given. That's why it's called long only. So these types of firms, you need to be aware of the jargon also. These types of funds are called long only funds. Okay, that means you're only allowed to hold net long positions. No, net short position is not allowed. Okay. So the difference in AM versus TAM is, in AM you can go both ways. Okay, you've heard of many short funds, like there are many short, one of the terms that you will hear is what is called long short equity. Okay, so this, I'll just put this term here. One typical type of firm is, if you see your mandate, essentially in the NSE project, the mandate that was given to you, okay, is, so this is long only, we already got it there, but I'm just writing it here again. Alright, so if you look at your NSE fund, the NSE fund that you were managing, that was what? Long short or long only? Long short, right? So there was no restriction given to you. The mandate included the ability to go net short, okay, if you could find the shares to borrow. Okay, so that's why, so this is a distinction that we make. The terminology, you need to be particular about the terms that you use. So in the TAM universe, these would be called long only funds, and in the AM universe, these are called long short funds. So one very common type of terminology, the term that you might see is, we say that I'm running a US equities long short fund, long short US equity. One name of a fund, typical name of a fund would be long short US equities. Okay, which means I'm operating which tells you that I'm operating only in US equities. I'm not trading Japanese shares or German shares. Okay, and it also tells you that this is an AM type of fund because it is a long short fund. Is this clear? Okay, most people they seem to be all lost in their own universe. Many of you are not engaged in the class. Okay, this and again invested as typically in the AM universe. Now, maybe I don't need to. Is it boring if I just go through this, or what? What should I just skip over this and let you guys read it on your own? Okay. So because everybody seems to be quite switched off. I don't know what the problem is. Everyone seems to be quite switched off. They're all lost in their own universe. It's like you're sitting in a class where somebody is talking in Norwegian or something, or some language which you don't understand. So. Okay, so TAM, essentially again we had the historical trend has been that we have invested. That's why you see we have invested only in equities and debt. That's why if you see, if you look at your traditional finance textbooks, okay, and if you look at your traditional MBA, in most of the MBA, even today, if you look at most business schools, you can ask your friends who are in other business schools, they would be doing these courses called SAPM, okay, which is Securities Analysis and Portfolio Management, okay, and even in the IPM, if they have in the IPM, most of these courses would focus only on equity and debt securities, okay, but because there are two other major asset classes like currencies and commodities which don't get covered, okay, that's why I teach finance from the comprehensive perspective, and that's the way you should look at it, that you can operate in any asset class. So TAM actually is like a special case of, so in most cases, if you see most business schools, the course on IPM or SAPM will focus on equities and debt. If you look at the textbooks also, if you look at your own textbook of that Bodike and Marcus, it will typically have an equities and debt focus, okay? Because that is coming from this historical trend of the TAM universe, okay? What the historical practice of managing investments only in equities and debt. And that's why those textbooks have that kind of narrow focus. But I feel it is more appropriate to study it from the broadest possible perspective. And then you see TAM is actually like a special case of AM. You remember the expression special case from mathematics? That a particular function is a special case of some other function.
Yes.
So if I have a function which can take both positive and negative values, okay, and then I put a constraint on that function saying that then I come up with a variant of that function which can only take positive values. So this function which can only take positive values becomes a special case of the more general function which can take both positive and negative values. You remember this kind of discussion from maths? Some of you do, right? Okay, so this is basically what another way to look at this is actually, although we call this traditional asset management or this is the mainstream approach, this is still the mainstream approach. TAM is still the mainstream approach, okay? Most of the funds are still managed under TAM. But actually if you see it logically, TAM is actually a special case of AM. Can you see that? You should start to look at it from that point of view. TAM is a special case of AM because in AM you can go long short and in AM you can go only long. So this is the same as like a function takes both positive negative values, but in the variant you put in a constraint that this can take only positive values, so that's a special case of that function, okay? So are you following this? So you can actually think of TAM as a special case of AM, because in AM you have a lot more flexibility, and in AM you find that generally the flexibility is much less on many fronts, okay? So one front we can see where there is limited flexibility is on this business of going long and short. You can't go both long and short, you can only go long, net long, okay? Second is asset classes that you can invest in, okay? Only, as we see here, in TAM, we can only go into these two, right? We can only operate in these two asset classes, equities and debt, in TAM. But in AM, we are free to operate in any asset class that we want. Is this clear? And even real estate funds, you might see many, even Indian firms like Edelweiss, some time back, they closed a real estate investment fund. So that would also fall under AM. Okay, so that fund is now focused, that fund is focused purely on real estate. The job is to just basically go and make investments in various real estate projects. Okay, so that's an AM fund because it doesn't fall under the TAM umbrella because it is outside the realm of equities and debt. Is this clear? So TAM, again and again, you'll see that TAM is a special case of AM. All right. Okay, and AM obviously you can invest in any asset class. Okay, so. Okay, investable instruments type, typically cash and spot only. Okay, so this is what you have. Again, in AM, in TAM, you are confined. So you can see how the basic nature of AM relative to TAM is all kinds of restrictions, which don't exist in AM. Okay, now here again, when you go into TAM, you are being confined to cash and spot markets. Okay, you are not typically allowed the typical mutual fund, the typical TAM vehicle will not have the right to invest in derivative products, okay? Which means, what are your derivative products? You see that? If you leave out cash and spot, on the other side you have the orange line. These are your derivative products. Can you see that? This orange line. Here, this orange line, derivative products. This covers all this stuff, right? Yeah?
Yes.
Okay. So therefore, one of the characteristics of TAM funds is that they are not allowed to invest in derivative products. So they are confined to these cash and spot markets, okay? So all kinds of restrictions, these are all the various aspects on which you have restrictions. Here in AM you can do anything, options, swaps, futures, whatever you want to do. Okay, typically, unless you put some of your own constraints. There are many funds which are highly specialized. They are only options funds, and then they only sell options. Okay, so you could have some funds which are very specialized. Okay, so these will be AM funds, but these are restrictions that they have chosen to put on themselves. Okay, the fund has chosen to put these restrictions on themselves because they want to target a particular type of customer. Okay, but in general, in AM funds, everything is allowed. Okay, it's a very there's a lot of flexibility. Okay, now another point on which there is a restriction in TAM, leverage. You remember what leverage is? Leverage is not debt. Okay, let's have this discussion. Okay, fine. Yeah. Okay, okay, fine. So you can say use of debt in that sense. So because I have not asked you the question in a sufficiently specific manner. Okay, what is the, let's say, how would you calculate leverage? If I rephrase the question, your answers are correct in the general way that I asked the question. Your answers are okay. Use of debt, etc. But now, if I say, how would you calculate leverage? You have set up some leverage for your O&A accounts. 100:1. You've set up O&A accounts. We had this discussion in the class, remember? Now, if I rephrase the question and make it more specific, how would you calculate leverage? What is your answer?
It will depend upon the ratio, you can change the ratio.
The answer is not good enough. Answer is not good enough. Question is clear? How would I calculate leverage? If Wanda is giving me 100:1 leverage, what exactly does that mean? We've discussed this in the class. We have actually discussed this in the class. When we were doing our classes in the finance lab, I remember discussing this in the class. Let's do it one more time, guys.
We can buy for $800. If we have $1 in our account,
Yeah.
we can buy for $100. That is
Yeah, you can buy, but it needs to be more specific. This is what Dipanshu mentioned the other day when we were discussing this. Okay, when I discussed leverage, when we had this earlier discussion, which all of you or most of you have forgotten. So let's get this clear. Leverage equals total position value divided by account equity. Okay, I will put this into your notes one by one. But I'll put this into your notes, but let's first just discuss and understand this. Just recap quickly, guys. Most of you have forgotten. I don't know why your retention is so poor. Okay, so when I ask you, how would you calculate leverage? This is the mathematical answer. Leverage equals total position value divided by account equity. Okay, clear? And then of course the question is, what is your total position value? Then the question might arise, what is TPV?
So it is number of shares into price, number of shares, I guess it is the number of shares into price of.
No, but again you're not answering in a general enough way.
So not shares, we can say the number of securities.
No, that is also not general. You should say assets.
Exactly.
Because all assets are not securities, but all securities are assets. Okay, so your answer should always be given in as general of framework as possible, as general sort of frame of reference as possible. So the answer is so the total position value is simple price per unit into number of units. Okay, number of units bought or sold. Is this clear? So this is the mathematical answer. Okay, if I ask you how would you calculate leverage? Leverage equals total TPV by AE. Okay, and AE, you understand, AE is the amount of money that you have actually put into your account. Okay, your equity, your net worth as it recalculated, the equity, and after you've started trading, you have some unrealized losses, etc. Then your net worth will obviously go down. So therefore, leverage equals TPV by account equity, and TPV equals number of units into unit price. Okay, so all right. So is this clear now? This is what leverage is. Okay, this is how you calculate leverage. Your general answer is okay for the first question, which I had not framed in a sufficiently specific manner. So once again, in TAM, no leverage is allowed. In typical mutual funds, they are not. If they have 1,000 crores of assets, okay, 1,000 crores of investable funds, the maximum amount of securities they can buy is 1,000 crores. at that point, okay? And then those securities might appreciate in value, and then they may sell some of them, get some realized profits, etc. They can invest more with that, okay? But the point is they cannot use leverage, so they're essentially what will happen is if we go back to this formula, what does this mean? Leverage has to be confined to, leverage cannot be more than 1. So TPV has to be always equal to account equity. Is this clear? Because leverage cannot be more than 1, okay? No leverage is allowed, okay? What that means essentially is, again, no leverage is allowed is an English language way of stating it. Mathematically, the way you would state it is that leverage must be less than 1, okay? That is the way to state it mathematically, okay? Is this clear, guys? Okay, no leverage is used. I must have given them a link to leverage, okay? So, and in hedge funds, in AM, okay, all kinds of widespread leverage is allowed, okay? Depends on how much leverage your counterparty is going to allow you. How market makers, if you're trading with a particular market maker who is maintaining your account, okay, like Oanda is an example of a market maker. So Oanda is allowing you 100 to 1. Now it's giving you lots of options, okay? And you'll notice in some functions, like I think Tanuj went and opened an account with Oanda Canada, and his leverage was being restricted to 50:1.
Yes, sir.
Okay? Yeah. 50:1. So actually then we need to find out now why is this happening? Remember I answered this when Giri was asking this question. So this is how OTC markets get regulated, because the Canadian regulators must have put in a rule that saying that because Oanda Canada has to be incorporated in Canada, it needs an operating license in Canada, so it has to follow the Canadian regulations. So in the Canadian regulations, they must have put in this rule that, okay, we'll let you operate here, but you cannot allow anyone opening an account with Oanda Canada to have leverage of more than 50:1. That's why there you see 50:1. Some other jurisdictions would give you maybe 100:1. Okay, so it all depends on, this is how regulation is done in the case of OTC markets. Okay, individual, you have to operate somewhere, so you operate right. Now again, next point, benchmarks for performance evaluation. This is very important. You already seen one case in one of your projects where you have done where you had an example of performance evaluation. What is the benchmark that we used in your IPM project? No. How did you guys get ranked?
Sir, maximum drop down.
Maximum drop down.
Sir, ऐसे बोला था आपसे. नहीं, maximum.
What is the actual metric that we used?
Sir, NAV about maximum.
Not NAV. Percentage return. Okay, so the metric that we used was percentage return over the period divided by the maximum drawdown over the period. Okay, so what we used, the measure that we used was total profit to maximum percentage profit to ratio of percentage profit to maximum drawdown. Now you remember all that, how drawdown was calculated?
Yes, sir.
Right? Now many of you have, now if I ask people about what is drawdown, most people will not remember.
Sir, peak to trough.
Yeah, maximum peak to trough, drop in equity value. Okay, so in any given chart you can see, if you think that dollar Swiss is, let's say, forget about this being dollar Swiss, let's say this is a chart of your account equity. This is a plot of your account equity. Okay, so this is what, cross-sectional data or time series data? Time series data. Okay, so this is a plot of your account equity. So drawdown here means maximum. Let's say you started from here. Okay, so here obviously the maximum drawdown is going to be from here to here. Okay, because there's no other place where there's maximum draw of this magnitude. But these are also drawdowns. From here to here, this is also a drawdown, because you made this much profit, then you lost this much. This is also all drawdown. So these are also drawdown. This is also a drawdown. Okay, but then you take the maximum drawdown. You take the maximum percentage loss in account equity from the previous equity peak. This is clear. That's maximum drawdown. So the metric that we used to evaluate your project, okay, was, because it was an AM project. Because it was an AM project, we used a metric that would be typically used in the AM universe, okay, which is percentage profit divided by maximum drawdown. Okay, Remember that this is a measure of risk adjusted return or absolute return? Risk adjusted return. Okay, so and what is representing the risk here? Yeah, that maximum drawdown number is meant to proxy your risk. That this is how risky your trading style is, that you have lost so much money. Eventually you have made more money than when you started with, okay? A little bit more money that you started with, but you have lost so much money. So this shows you that your fund is quite risky. The way you're managing your fund, it's quite risky. So this is a measure of risk. So therefore there is a risk adjusted in both TAM and AM. You will use measures of risk adjusted return, okay? But the measures tend to be different. So one of the measures you might use in AM, okay? That's why I gave you an AM measure, is this kind of measure. Percentage profit to maximum drawdown. Okay, it's a very simple measure and it gives you a perception of, so if you made, let's say you made a 45% profit, okay? But you had a maximum drawdown of 15%. So your ratio would be 3. Okay, your ratio would be 3. So this is how you get and so somebody else who has made a profit of 90% with drawdown of maybe just 3%, his ratio will be 30. So he's deemed to be a much better fund manager than you because he has a ratio of 30 of profit to maximum drawdown. Okay. So another ratio. So this is one example of a ratio that might be used. Now we are talking about performance evaluation. Okay. We're talking about performance evaluation. So another ratio that might be. So this is one example of a ratio that would be used. This is used in the AM universe. Drawdown would typically not be used in the TAM universe. Okay. Time. Okay, great, excellent. Set your alarms. Okay, next time we'll set the alarm. Anybody has any technical question? Then I will not close the.